Robschild. No investment advice. Welcome to the Robschild Special Edition. Moody's Downgrade Explained. Treasuries and stocks at risk? Unless you live under a rock, you may have noticed many headlines coming out on Friday, May 16th, 2025, talking about Moody's, the credit rating agency, downgrading the U.S. credit rating. The other two major credit rating agencies already downgraded the U.S. credit rating, and now we have the third, Moody's, also downgrading the U.S. credit. With two of the agencies already downgrading it, and Moody's already cutting its outlook to negative previously in November of 2023, this was not completely unforeseen. This special edition goes over the Moody's downgrade explained, and after this section, we will go over its implications on its effect on treasuries and stocks. First up, why the downgrade? Well, number one, the U.S. government has been spending way more money than it makes. This is a chart from the Federal Reserve Bank of St. Louis, otherwise known as the Fred, very well-known website for getting information directly from the Federal Reserve themselves. This shows what's been going on every year in regard to, are we adding to the debt or are we adding to the surplus of the money of the U.S. government? Now, really, ever since 2002, we have been adding every year to the deficit a lot. In fact, in 2009, we added $1.4 trillion for the first time in history to the deficit. And then in 2020, adding another $3 trillion. And this is all while every year in between has been adding at least half of a trillion or more. The money that the U.S. government spends on things doesn't come out of thin air completely. They have to borrow this money, and the way they do this is they issue debt in the form of T-bills, notes, and bonds. And the more they owe people, the more they have to pay out in interest payments. And the problem right now is that interest rates are currently relatively high. They've been going up lately, and so it means that the government has to actually spend more and more money. Where are they going to get all of this extra money from? Are they just going to keep adding more and more debt? It's kind of like if you have a job that you're making $50,000 a year and you have a credit card and all of a sudden your bill on your credit card is more than $50,000. All of a sudden it's $100,000. All of a sudden it's $200,000. And the credit card company is looking at you and saying, really? You can handle all this debt? We're not sure if you can. So we're going to actually raise the interest payments that you have to make by lowering your credit score. And it's not exactly how this works because it's the U.S. government, but they still owe this money and they still owe these interest payments. Now, the United States issues a lot of different forms of debt of different lengths. Sometimes they lock in 10 years, 20 years, 30 years, sometimes all the way down to the Fed funds rate of overnight borrowing. But this is the 10-year Treasury yield, and it's not really controlled by the government or the Fed. It's mostly controlled by what people are willing to accept as a yield on the debt of the U.S. government. And this has, since 2002, since the deficits have been really ballooning up, you can see the cost of interest payments has actually been dropping. In fact, in 2002, it cost about, let's say, $5 per year. So the government has to pay out $5 a year to borrow $100 for the next 10 years because this is a 10-year Treasury note. Now, over time, this has been dropping all the way down, during the Great Financial Crisis, and soon after, all the way down to only $2.62 per $100. So that's a lot cheaper debt. So why not just add more debt since it keeps getting cheaper? And it just kept happening. 2012, we got only $1.47 per $100 of money borrowed. And then all the way down in 2020, to only costing 64 cents per $100 borrowed by the U.S. government. Now, this is sort of what happened in Japan, where they were able to increase their deficits to seemingly infinite amounts because the interest payments were so small. It's like, yeah, we can handle these interest payments because they're so low. However, since 2020, they are no longer 60 cents per $100. In fact, today they're closer to about $4.50. This is all while the total amount of debt that the U.S. holds is around $37 trillion. This is why these credit agencies are able to say, hey, we're starting to get worried about this situation, because if you keep just issuing more and more debt in order to pay off your debt, that's like, someone having an enormous amount of borrowing on their credit card, a huge credit card bill, and just saying, I'm just going to get another credit card and pay off that credit card with this credit card, and I'll get another one. And then meanwhile, continuing to spend more and more and more money. It's a problem, especially when the cost of the interest payments isn't actually going down. It's been going up. Now, with all of that said, this is the U.S. government, and they can just continue to keep borrowing, but it risks potential hyperinflation, where people just don't trust the whole monetary system altogether. So what's essentially happening here is the credit agency is simply signaling to the United States government, hey guys, we see problems here, and we need you to get your house in order. And there's two ways of doing this. Number one, all that debt needs to start going down. And the only way to do that, really, is to raise taxes and or lower spending. So if you remember the guy with a credit card, the credit card agencies come to this guy and say, hey, you got to slow down. You got to stop spending so much, or you got to start making more money. I don't know where it's going to come from, but you owe us that money, and we're worried about you paying that off. One way of raising taxes that is being done right now, that's the reason we have the tariffs, which is why I find the Moody's downgrade to be a little interesting for its timing, considering that this whole tariff thing has just really begun, and that this actually indeed raises taxes. This does help with the debt burden of the United States. But with them lowering the credit rating, it's sort of saying, hey, we really need to see these tariffs and or other ways of money coming in right now. So while some people believe the whole point of this tariff thing is to nationalize production, all that kind of a thing, it has more to do with what's going on in the finance world more than anything else. Now, Robschild, I thought I saw recently in headlines that the U.S. Treasury just shocked everybody, saying they had a surplus in April. You're right. You saw numerous headlines talking about the Treasury announcing that they actually just had a surplus, referencing tariffs and other things. But if you dig just a little bit deeper past the headline and go to the monthly Treasury statement itself, you can see that a surplus, in other words, this number being negative, deficit, surplus, negative. So a negative of a negative is a positive. A negative number here means a positive, a surplus, and all of the non-negative numbers actually mean a deficit. While it does look like $258 billion surplus, well, that's great. Yeah, until you realize that pretty much every April there is a surplus. As you can see, we have April of 2024 with a $209 billion surplus, and then in 2023, $176 billion surplus. And besides directly post-pandemic, before that, it's a pretty consistent pattern where we see a surplus in the month of April pretty consistently, surrounded by added deficits. Well, why is this? Well, tax day, right? It's tax day. It's when people say, uh-oh, I need to pay more taxes, and they get a bunch of tax receipts. And I think it's more than that, more than anything. I think that headline was a little manipulative. So I think it needs to be taken with a grain of salt. However, if we continue to see, for example, in the next month's report, another surplus in May, another surplus in June, that is actually good news. But let's wait and see, is my take on the surplus deficit issue at this time. So next we're going to go on to the treasuries and stocks at risk portion of this video. What are the implications for the value of treasury bonds, let's say, and the value of stocks? Well, this is the third agency to downgrade the U.S. credit rating. So let's see what happened the last two times that this was downgraded, as well as when Moody's first lowered their outlook. What happened to the value of treasuries and stocks? The first one we're going to look at is the Standard & Poor's downgrade. This occurred on August 5th of 2011 from a AAA rating to a AA plus rating. So first we will look at SPX, the S&P 500 index. This pink line represents that day that it was reported, August 5th, 2011. What happened the next day? A 6.66% drop in the prices of stocks in the S&P 500. And then we got a pretty quick recovery and then found a new lower low. And that is the part that I want to focus on, is that we found a low and then a lower low before recovering. This must have been because yields were spiking, because bonds were losing their value, because everyone wanted to dump bonds, right? Is that what happened? To view the value of bonds upside down, we can take a look at TNX, the 10-year Treasury note yield. When this drops, when the yield drops, that means that the Treasury price actually is going higher. And this pink line right here is August 5th, 2011. And as you can see very clearly from this chart, we did not go up in yield, but actually went down to a low. And then later on, I want to note that we had found about 9 months after that, even a lower low. So we found a new low and then a lower low. So now we can add to this first date here of August 5th, 2011, that what happens to stocks? Stocks dropped and then later found a lower low. What happened to bonds? Bonds actually went up and found a higher high with yields dropping. So now we're going to move on to the second downgrade of U.S. debt, the Fitch rating downgrade of August 1st, 2023 from AAA rating to AA plus rating. Sorry ahead of time for the extra lines, but here we have it. August 1st, 2023. What happened? We found lower low, lower low, lower low 3 times, dropping about 10% on the S&P 500 before resuming a bull market to going higher and higher. So what about bonds? Again, sorry for the extra lines. We want to pay attention to this pink line here. This is the 10-year Treasury note yield. As you can see, it actually spiked. Rates went way up, so the value of bonds had dropped initially before going right back down to where we were before by December of 2023. And then since then, continuing to go to find a lower high and a lower low in Treasury note yields. And then since then, kind of going sideways more than anything else. So now we can say the Fitch ratings downgrade. When that happened, stocks had a panic correction of about 10% before resuming a bull market. And then bonds had a bit of a panic drop, which reversed straight back up. And then we found higher highs and then really going sideways since then. Now for the third time, we were talking about the credit rating of the United States when Moody's had their outlook cut, but without a downgrade occurring November 10th, 2023. Again, please excuse all of the other lines on the chart. This pink line represents November 10th, 2023. In the SPX, the S&P 500, and stocks just went ballistic to the upside, not going down. Again, this wasn't a downgrade, this was a change of outlook. I want to also note that the 10-year Treasury note yield, you might think, it might spike up here. Instead, it dropped, and that's when we were really going lower and then finding a new lower low before then resuming sort of the sideways chop until where we are today. So in both instances, when the actual downgrades occurred in Standards & Poor's and the Fitch rating, stocks dropped pretty strongly, 6.7% and then 10%, while when only outlook was cut, stocks were actually in the middle of skyrocketing. But bonds, surprisingly, you think you get your credit rating cut, that means your interest payments have to go up. That means bond prices should go down. However, in both of the first downgrades, bonds actually went up and found a higher high in the first instance. And in the second instance, there was a panic drop in bonds, but then when it turned into a blow-off bottom, going straight back up to its original price, and then later finding higher highs, and then going sideways. And since the outlook cut, bonds also found higher highs. So based on these instances of credit ratings being talked about and downgrading, I don't think it would be unreasonable to expect stocks to drop here. And in the immediate short term, perhaps bonds, they can drop, but they can also go the other way, depending on if there is a run to safety where bonds and stocks are in a correlated state when stocks are going up and bonds are going up, or both going down at the same time, or an uncorrelated state when stocks are dropping and bonds actually going up. Over the past few weeks, if you've been watching my show, you've noted that stocks and bonds have actually been in an uncorrelated state, which means when stocks have been going down, bonds have been going up. If you add to that the fact that Treasury yields right now are in the highest range that they've been in for a long time, if I were to guess, I would think that this is one of those cases where we actually get a run to Treasuries while stocks sell off here. But at the end of the day, we don't really know because no one has a crystal ball. And that's all for Robschild's special edition, Moody's Downgrade Explained, Treasuries and Stocks at Risk. I hope you enjoyed, and see you next time. Robschild.